guys. We're going to go over Chapter 12, Lecture, Accounting for Partnerships, and it will follow along with the book. I'm going to try to stay out of the picture as much as possible so you can see the whiteboard as much as possible. So we're going to start with partnerships, the definition of a partnership. Defined by the Uniform Partnership Act is an association of two or more persons to carry on as co-owners of a business for profit. So it's two people that have gotten together and said, hey, let's do business. There are some characteristics about a partnership that you will want to know, and those are going to be listed on page 2-3 in your chapter, and you can just kind of follow along. The first one is the association of individuals. Partnerships are voluntary associations of two or more individuals, and it's very easy to form. It can be done by just a handshake, but most commonly there is a partnership agreement that is drawn up by an attorney. That we'll talk a little bit more about in a little bit. It represents an accounting entity for financial reporting purposes. There is a tax return that is filed. It's called a 1065, but it is filed for information purpose only. We'll talk about how this flows through here in just a second, but the income or loss from the partnership will flow through into the partner's returns. The information on the partnership return, the 1065, tells the Internal Revenue Service where those the net income or loss has gone to whom. Mutual agency, this one you need to know for the test what that one means, and it is that each partner acts on behalf of the partnership when they engage in partnership business, which is not always a good thing. The act of any partner, even if they act out of their scope of their authority, is binding by the other partners as long as the act appears to be appropriate for the business. So let me give you an example for that. If I am in a partnership with someone and we have a flower shop, and I go down to Power Planet Sports and say, hey, we're going to get a snowmobile because by golly, it doesn't matter if we get snowed in, we're going to deliver our flowers. That would be out of the usual norm for a flower shop to have a snowmobile to deliver their flowers in the winter. However, if my partner went down to the local car dealership and bought a small van, that would not be out of the ordinary. Most flower shops do have a delivery vehicle, it's just not a snowmobile. So my act would not be binding through mutual agency, but their act would, and I would have to take on that debt as well. Limited life, just like we had in Accounting 101 with a sole proprietor, a partnership has limited life, which means that it is dependent on the partners that are involved in the partnership still being alive. Any changes made to the group in the partnership creates a new partnership, so the old partnership is no more, and we'll talk about that throughout the chapter as well. But so if there's a death of a partner, the dissolution of a partnership happens. If a new partner comes in, that partnership ends and a new partnership begins with the 3 people instead of the 2. If there were 3 people and one leaves, then another partnership begins with 2 people instead of 3. So it is dependent on the life of the partners. Now, operations can continue as normal for the business if there's a change in partnership ownership, but it's just a new partnership. So a new partnership agreement would be formed. So if there was 2 and we added a 3rd one, we would have to create a new partnership agreement. If there was 3 and we went down to 2, same thing would have to happen. Unlimited liability, we talked about this with the sole proprietorship as well, and again, you need to understand what this is for the test. Each partner is personally and individually liable for all partnership debts. That means that they can come and take your stuff, just like they could come and take your stuff for Accounting 101. if you cannot if the business cannot satisfy the business debt, then they can look at the owners for the assets to satisfy that debt that needs to be done. And that is regardless of the partner's equity in the partnership. So it wouldn't matter if I had more equity than my partner, and if my partner had more stuff to take, they'd go take their stuff. Whatever is easiest is what they go after, and not necessarily who has the most wrapped up into the partnership. There is co-partnership of property, which means that the assets are all owned jointly by the partners, which means that if I put in a computer into the business, that doesn't mean the computer stays mine. It becomes the partnership, so it's jointly owned. It's not, I don't have claim to those assets. It's the only thing I have in the partnership is what my capital account is. So the assets would generally be sold, and then I would get my capital amount, which we'll talk about later in the chapter as well. If the net income or loss is not specified differently in the partnership agreement, then it is automatically assumed to be split 50-50. So the partnership agreement would list anything different. So let's say if I did more management of the business on a daily basis than my partner, we might split it 60-40. That would need to be spelled out in the partnership agreement. Otherwise, it's assumed to be a 50-50. On the next page, we're going to talk about organizations with partnership type characteristics. The first one is a limited partnership. You need to know for the test on this one that the general partner has unlimited liability, while the limited partners have limited liability. And they're generally not active in the business either, just the general partner is. The next one is an LLP, or a limited liability partnership. This one protects innocent partners against malpractice or negligence claims resulting from the acts of another partner. So generally this is going to be found in lawyers' offices, doctors' offices, accountants, those types of businesses would have LLPs. An LLC is a limited liability company. This has a limited life. The owners are called members, and they do have a limited liability like the owners of a corporation. These members can be active in the business management daily activities. So with an LLC, the business members, or the members of that LLC, is eligible to be active with the daily work. Disadvantages and advantages of partnerships. You will want to look on page 12.5 for that. There's an illustration 12.1, and you'll need to know these for the test, which ones are advantages, which ones are disadvantages. The first advantage is that the skills and resources of two or more individuals can be combined. Sometimes it's better to put two heads together to come up with ideas when it comes to a business than it is one person trying to figure everything out for themselves. So if you had two sole proprietors and they put their heads together and said, hey, you know, I'm good at fresh floor arrangement, but you're good at silk floor arrangement. So if we put it together, then we've got the whole bases covered. So they may decide to form a partnership instead of two sole proprietors. The skills and resources of the two of them put together is worth more than the two separated. It is very easy to form. Like I said, it can be done with a handshake, but I suggest strongly that there's a partnership agreement drawn up by an attorney that spells everything out, which we will talk about the partnership agreement here in a second. It is relatively free of governmental regulations and restrictions. You don't have a bunch of red tape to go through, or hoops to jump through. You are pretty much like a sole proprietor, only there's two of you working together or more. Decisions can be made easily since there's no board of directors. With a corporation, when we get into that later, starting next chapter, you will find that things have to be ran through a board of directors, and that's when you get into a lot of red tape and hoops to jump through. So the partnership is a lot like the sole proprietor in the fact that you don't have all of that. And decisions can be made easily. You can have coffee at Big B and decide, hey, let's give this a shot for our business, and boom, you can do it right away. You don't have to get any approval anywhere. The disadvantages, we talked about mutual agency. That's when an act of one partner can be binding on both partners or all partners, no matter whether that should be in their scope of authority or not. As long as it looks like it would be a normal transaction for that particular business, then it is binding. So mutual agency is considered a disadvantage because of that. Limited life, we talked about how it's reliant on the partners. So once the partnership formation changes or something happens to one of the partners, then it's done. So it's very limited and relies on the partners heavily. The next one is that unlimited liability. That would be considered a disadvantage. If they can come and take your stuff, that's always going to be a disadvantage. So unlimited liability means that's what they can do. And remember in 101, I told you they don't come take the stuff that you want them to take. They come and take the stuff that you don't want them to take. So know those out of that illustration there on page 5. The partnership agreement, then, I've mentioned that several times already, is on page 6. There's 7 things listed there that should be definitely included in a partnership agreement. This is not an exhaustive list. You can add anything else in there that you think needs to be covered, but this would be the minimum. But know for the test that the partnership agreement is a written contract that establishes the duties and responsibilities of the partners. So it's going to list out who is the partners, and it's going to list out what their jobs and responsibilities are going to be within this partnership that they have created. Now, a partnership agreement is also called an Articles of Co-Partnership. You don't need to know that, but just in case you hear that terminology. This agreement that is drawn up should try to anticipate all possible situations among the partners. So right now, it just may be you and Susie. Well, what if Tony decides to join? Then we're going to have 3 people in here, and if we don't cross that bridge in the partnership agreement, then we could have issues. So you always want to try to anticipate any possible situations that could come up in the future, and then tackle those in this partnership as far as to how the partners want to handle it. We're going to take a look at do it 2-1 and exercise 2-1 in the back of the chapter. So let me get to the page and I'll tell you where to go. Do it 2-1 is on page 31. Indicate whether each of these statements is true or false. If false, indicate how to correct the statement. Number 1 says each partner is personally and individually liable for all partnership debts. That is correct. That is true. That is that unlimited liability thing, just like it is with the sole proprietor. Number 2, if a partnership dissolves or is no more, each partner has a claim to the specific assets that he or she contributed to the firm. That's false. That goes back to me saying that if I put a computer into the partnership, it becomes the partnership asset, not mine. So it does not go back to its original owner if the partnership goes out. Number 3, in a limited partnership, all partners have limited liability. That is false. The general partner has unlimited liability. The limited partners have limited liability. Number 4, a major advantage of regular partnership is that it is simple and inexpensive to create and operate. That is true, just like it is with the sole proprietor. The sole proprietor could wake up one morning and say, hey, I'm going to start this business, and they do. It's the same concept with a partnership, so it is very easy to do. Number 5, members of a limited liability company can take an active management role. That is correct. In an LLC, the members are allowed to be active in the daily business. And I said we were going to do exercise 2-1, which is on the same page you are on now, page 32. Same concept here with the sentences. A partnership is an association of 3 or more persons to carry on as co-owners of a business for profit. That is incorrect. It only takes 2. So it can be 3, but it only takes 2. Number 2, the legal requirements for forming a partnership can be quite burdensome. We just talked about that. They're not. They're very, very easy. You can handshake and you've got a business, or you can just discuss over coffee and you've got a business. Not recommended, but it can happen. Number 3, a partnership is not an entity for financial reporting purposes. That is incorrect. It is. And to the extent that a tax return has to be filed with the partnership's information, for information purpose only for the government. Number 4, the net income of a partnership is taxed as a separate entity. That is incorrect. It flows through into the individual partner's returns. It's actually done on a Schedule K1. That Schedule K1 is included in the 1065, which tells the government where the income or loss has been split into whom and by how much. And then the K1s are reported on the individual's tax returns. Number 5, the act of any partner is binding on all other partners, even when partners perform business acts beyond the scope of their authority. That is true as long as the act could be considered normal for that type of business. Number 6, each partner is personally and individually liable for all partnership liabilities. That is true. That goes back to that unlimited liability thing. They can come and take your stuff because you are responsible for the partnership liability. If the partnership cannot sell all of its assets and take care of the liabilities that it has, then it can come and get your stuff. So that means you're personally and individually liable. Number 7, when a partnership is dissolved, the assets legally revert to the original contributor. We just talked about that one in the other one. That is not true. I can't get my computer back. I mean, I can if I want to take it out of my equity, but it doesn't automatically revert back to me if we dissolve the partnership. Number 8, in a limited partnership, 1 or more partners have unlimited liability and 1 or more partners have limited liability for the debts of the firm. That is true. That goes back to the general partner being the unlimited and the limited partners being the limited people. Number 9, mutual agency is a major advantage of the partnership form of business. That is incorrect. It is a disadvantage because that makes both people liable for an action done by one that could or could not really have been wanted by both. Usually not. Partnership accounting, going on to back to page 7. I told you, again, forming a partnership, the initial investments should be recorded at fair market value at the date that things are transferred to the partnership. Now, what we're going to learn is 2 sole proprietors have come together over coffee or over donuts or at Big B or wherever, and they have said, okay, you have this business and I have this business, but if we work together, we could make a good team. So they're going to combine 2 sole proprietors into 1 partnership. So that's kind of what we're talking about here. Anything that comes into as an initial investment by either one of the partners into the partnership is going to come in at what is considered fair market value. What is it worth right now on the market at the date of its transfer into the partnership? Know for the test that accumulated depreciation is not brought into the partnership. And the logic behind that is because there has been no depreciation taken on it, so there shouldn't be any accumulated depreciation. Not only that, but you are bringing it in at fair market value. So you've already discounted it for its depreciated amount. So when it's brought in. So know for the test that accumulated depreciation, if you see it on a sole proprietor's portion, of what they're bringing into the partnership, it does not come into the partnership. The second thing about forming a partnership is that all partners must agree upon the value of the assets. So I can sit around and say, well, this is fair market value, and my partner can say this is fair market value, but at some point we have to meet in the middle, and it has to be agreed upon. So it could be two different amounts to start with, but in the end we have to say, okay, this is where we're going with this. This is its amount. So, and that's what's coming over. General accounting is similar to any other type of organization, so the stuff that you've learned in Accounting 101 is going to be pretty similar in Accounting 102 in regards to this partnership. It's just in 101 we have one owner, in 102 we're going to have, or in partnerships we're going to have two. So we had sole proprietor, one. Partnerships are going to have two or more. So in the 101 class, we had one capital account, one draw account. What you're going to find with a partnership is you're going to have a capital account for each partner and a draw account for each partner. So you're going to have two or more capitals, two or more draws. The steps in the accounting cycle are going to be the same as a proprietorship. You're going to go through that great big circle that we talked about before towards the end of, I think it was chapter 5, chapter 6, where I showed you how we completed the entire circle around, and it was a never-ending cycle of work. We start with journalizing the entries. We post them to the ledger. We do a trial balance. We do the adjusting entries. We do an adjusted trial. We do the adjusting entries. We post them to the ledger. We do an adjusted trial balance. We do financial statements, we do closing entries, we post those entries, and then we do a post-closing trial balance, and then we're back to square one where we start over with the next month or the next year's journal entries. Page 7 is going to take two sole proprietors and put them together into one partnership. So we're going to work through that real quick. It's the top of the page above the yellow. To illustrate, assume that Rolf and Shay combine their proprietorships to start a partnership named US Software. The firm will specialize in developing financial model software. Rolf and Shay have the assets listed in illustration 12.3, the yellow box, prior to the formation of the partnership. So you can see that we have book values. If you put your hand over the fair market value, the fair value side, this is what their sole proprietor books showed before they sat down and decided to become a partnership. Now, what you just covered up, the fair value, is the actual value of those things that they're going to bring into the partnership itself. So they've decided on these amounts. These are the fair values. This is what we're going to bring in and show in our journal entry. So you've got some cash involved, some equipment, some accumulated depreciation on the equipment, accounts receivable, and allowance for doubtful accounts. If you don't remember what that is the amount of the accounts receivable that we do not expect to collect. And we discount, so to speak, the accounts receivable total value by that amount on the accounting financial statements, so that when you look at the end of the financial statement there for accounts receivable, it's going to show what we really expect to collect, because you have the full amount of accounts receivable less the allowance for doubtful accounts, which is the amount you don't expect to collect. So you net that out, now we'll give you the amount that you do expect to collect. So we're going to look through all of these and see how this is going to work. Now when you do these for me, what I want you to do is one person at a time. So we're going to take a look at what Rolf has in there, and then we're going to take a look at what Shay has. So we're going to do one person at a time. So Rolf has cash and equipment and accumulated depreciation. If you look in the book value side and cover up everything except for his column, that's the three items that you see there that end up totaling 11 grand. So when we bring this in, cash is going to carry the same value that it did before. It's going to be the same fair market value as it is, let me see if I can write this a little bit bigger so you can see. So cash is going to come in at its same value as what he has on his books. So again, debits are going to be listed over to the right or to the left along the date line. And then you're going to have your credits indented. You're going to have a debit column and a credit column, okay, in your general journal. So he's going to bring $8,000 in for cash. Now the next thing he's going to have is equipment. Now on his partnership or proprietorship books, he had equipment and had a value of $5,000, but he had depreciated off $2,000 of it already. So its net or its book value on his proprietor books show $3,000 as its value. We have these two have sat down and decided that that equipment has actually got a fair market value of $4,000. So instead of carrying over its original cost and its accumulated depreciation and adjusting that, we just bring the equipment in at its new fair market value instead. So there is no accumulated depreciation coming in. So we're going to say equipment, and we're going to bring it in at that $4,000 agreed upon value. Now that's all he's bringing in. So at this point, you can just give him his capital. You can give him his amount that he has involved into the partnership so far. So you're going to indent because this is the credit. And that's his investment into the partnership. Okay, so that's one of the two down. Then we're going to look at Shay's stuff. Shay has some cash. $9,000 is going to come in, so we're going to bring in $9,000 for him. He has some accounts receivable in the amount of $4,000, and on his books it has an allowance for doubtful accounts of $7,000, which means if you net those two out, it's going to show on your balance sheet accounts receivable less allowance for doubtful accounts, and then the net cash realizable value is the difference between the two. So on his books, it would have shown that he expected to collect $3,300 of the $4,000 that was owed to him. Obviously, him and Ralph have sat down and they have said, okay, we are not going to collect that much. We're not going to collect the $3,300. We really only expect to collect $3,000 of that. So we are going to adjust the allowance for doubtful accounts for this. So we're going to bring in the accounts receivable at the full value. Again, remember that when we did Accounting 101, I said we never, unless we are completely writing somebody off of the books, we don't ever adjust accounts receivable for the balance sheet, its actual number. We do it through the allowance for doubtful accounts. So we're going to go ahead and bring the accounts receivable over at its full value because we don't have any way of really knowing which ones of those are going to pay and which ones are not. So we're going to go ahead and bring them all in. So we're going to bring in the whole four. And then we're going to make the adjustment down to, we're going to take this on the balance sheet down to being only 3 by adjusting the allowance for doubtful accounts. So that is going to be a credit because remember that's a contra asset and we abbreviated it ADA before. It's now going to be $1,000 so that takes the allowance or the accounts receivable down to a value of 3 that we do expect to collect. That is all that Shay has coming in. So at that point, we go ahead and give him his capital. So we have 9 and 4 is 13 minus 1. That means he has 12,000. Okay. So that is how we want want you to do it. Take one person at a time, look at each line and find out what they're bringing in, make sure it's coming in at fair market value, make sure that any accounts receivable gets adjusted through the allowance account to what you would really expect to collect. Make sure that any equipment comes over at fair market value and that the accumulated depreciation does not come in. So these two entries would be done in the partnerships books right off the bat to show what they're bringing in as investments, and then a balance sheet would be done. So it's not going to show you that in your book, but I think you're going to be doing that. So let me show you how that is going to look real quickly. A balance sheet, remember, you're going to start with your assets. You're going to have your heading, but then you're going to start with your assets. We have cash, accounts receivable, ADA, and equipment. So you're going to start with cash. And that's going to be the 8 plus the 9, so 17. Then you're going to show accounts receivable. If we were doing a classified balance sheet, you would call these current assets. Okay, so you're going to list out your current assets. Cash accounts receivable, I'm going to bump it over to another column, so that's going to be 4,000 less ADA of 1,000 gives me a net cash realizable value of 3,000. Then I'm going to bring my equipment in. If I'm doing it classified, I would say total current asset. Give myself a little bit of room so I don't have to abbreviate. So the 17 and the 3 would give me 20. Okay. Then I would say PP&E. I only have one. That would be the equipment. And I come in as a 4. Then I can total my assets, which is 24. Then the other side of the balance sheet is going to be the liabilities and owner's equity. I don't have any liabilities. I just have owner's equity, which is going to be the 2 capital accounts. We have 12 and 12. So the total liabilities and owner's equity equals the 24. Fix these before you tell me I didn't do my dollar signs right. Okay, so that would be what we would do. At that point, then you're going to start adding things together. Like this is cash and this is cash, so the two of them is this cash. If they both had accounts receivable, you would add the full value, and that would go here, and then you would put in the 2 ADAs, and that would go here, and then you would net the two of them together. So just a quick review on a classified balance sheet, because like I said, I think that's something that is going to be part of your homework. Exercise 12.1 and 12.2. So we're going to go back to page 31. While you're going there, I'm going to erase the board. Okay. So brief exercise 12.1. Barbara Ripley and Fred Nichols decides to organize the All-Star Partnership. Ripley invests $15,000 cash. Nichols contributes $10,000 cash, and equipment having a book value of $3,000. Prepare the entry to record Nichols' investment in the partnership, assuming the equipment has a fair market value of $4,000. So we're looking at just Nichols. I know that gave you some information on both of them, but we're going to just look at Nichols in this case. So Nichols is bringing in cash. So cash is an asset, going to be a debit again. Nichols is bringing in $10,000. Also going to be bringing in equipment, and they just gave us a fair value for that of 4. And that was all they said Nichols was going to bring in. Now they could have told us what his or her accumulated depreciation was in the sole proprietor, but it wouldn't really matter to us because when we're putting it into the partnership, we don't bring it in anyway. So at this point, we can just say Nichols capital is 14. And that is that entry for his or her coming in, Fred Nichols, so him. And then we were going to do brief exercise 2, so right underneath it. Penner and Torres decide to merge their proprietorships into a partnership called Pentor Company. The balance sheet of Torres Company shows accounts receivable less an allowance for doubtful accounts and equipment less accumulated depreciation. The partners agree that the net realizable value of the receivables is $14,500 and that the fair value of the equipment is $11,000. So we need to take a look at how that was going to look, bringing it into the partnership. So let's start with the accounts receivable because that would come first on your balance sheet. So looking at the accounts receivable, remember when you bring it in at full value. Since you don't have any way of knowing who isn't going to pay and who is, you just bring it all. So 16,000 is going to come in. And it's asking you to indicate how they would appear on the opening balance sheet. So it's not a journal entry. We're looking at the balance sheet itself. So underneath that would be the less allowance for doubtful accounts. So the amount we don't expect to collect. Well, they didn't give us that. What they did give us, though, is the amount we do expect to collect. So I can just kind of put a line here and say, well, my net cash realizable value is $14,500. They did tell me that. So I know I start with this as full value, and this is where I want to be. So the difference is the amount that I don't expect to collect. So $1,500. So you just kind of do a little bit of math there to fill in that blank. Then when you get down to the PP&E section, you would have the equipment. Now, in the instructions, it gave you the value for equipment plus accumulated depreciation for that equipment. The accum doesn't come in, so we have to take a look at the fair value that they're saying that we're going to give it, which is in the paragraph below, and it says 11. So we're just going to put it in at a value of 11,000. So that would be what things would look like on the balance sheet itself. Okay, back to the chapter, page 8. Dividing net income or net loss. You need to know for the test that that is done through the closing entries. And it's done in the very last part, the very step number 4 of closing entries. The net loss or the net income is going to be divided equally among the partners unless it's otherwise specified in the partnership agreement, so you have to pay attention to what they say they're doing. The basis is referred to as the income ratio, income and loss ratio, or the profit and loss ratio, so it can be called several different things. When we look at the closing entries, just a quick review here, there are 4 closing entries when we close out our books. first one is to close all revenues to income summary. And remember, revenues like to be a credit, so that is done with a debit, and income summary would be our credit. In the second entry, we close expenses to income summary. Now we also learned in chapter 5 that this also includes contra revenues. So your sales discounts and your sales R&A, those also close here. Sales returns and allowance. Those also close with the expenses. Expenses like to be a debit, so they are closed with a credit, which means income summary is my debit. Now in step number 3, there are two things that could happen, but either way, what you're doing is you're closing income summary to the capital accounts. I have this highlighted, but this is when you're going to actually divide out the income. Close income summary to capitals. So the first thing you have to do is determine your income, and then you have to decide how it's split between the partners. And then this one you have two possibilities. You can have a net income, or you can have a net loss. Either way, you're looking at doing something with income summary and capital. So both options, those are your two choices, and it would be more than one capital. I'll just put 2 here. Okay. Let's sort that down. So let's take a look at what we've done in the top 2, so that you can see what I'm talking about here. In step number 1, just looking at income summary, we credited income summary for the revenue dollars, so that's going to be here. In step number 2, we debit income summary for the expenses, so those are going to be here. Okay. If that is the case, then we are looking at expenses can be higher than revenues, or revenues can be higher than expenses. If revenues are higher than expenses, we have net income. If expenses are higher, then we have a net loss. That's why you have the 2 options. Okay, so if you have net income, then your balance is going to be here, not here. Okay, and you would have to debit income summary to close it, because that's the one you're closing. Remember, you are not closing any capitals right now. You're closing income summary. Okay, so if I have net income, then my balance is here. It would take a debit to income summary and a credit to my capitals. Okay. If I have a net loss, my balance is here, and if I want to close this account, then I would have to credit my income summary and debit my capitals. Now the only difference in this step, like I said before, is you're splitting up the amount down here for these guys. If you have a number here, let's say it's 10,000, and and it's net income, and it's a 50-50, then you would do the whole 10,000 here, 5,000 and 5,000 with each partner's capital. If it was 60-40, then one of these would be 60 or 6,000, 60% of that, and the other one would be 4,000 or 40% of that. So that is how you're going to split that out. So that's where you're going to do that. What I told you before, that you're going to divide the profit and loss between the partners. Once you get that done, then step number 4 is to close draw accounts to the capital accounts. Okay? Each partner has capital, each partner has a draw. So if they have taken anything out as a draw, then you're going to credit your draw and debit your capitals for each individual partner's account. So my draw goes against my capital, my partner's draw goes against their capital. Know that for the test, that in this step here, each partner's capital account will be debited for their particular amount that they withdrew. Drawing accounts, again, are temporary accounts. Revenues are temporary, expenses are temporary, contra revenues are temporary, income summary is temporary, and so is draws. So those are all temporaries, that's why we're closing them. 12.9, we're going to work through an example here and see how we split that out. So we're going to be looking at this transaction right here, number 3, and how we would want to record it. Top of the page. To illustrate the last 2 closing entries, assume that AB company has the net income of $32,000 for 2022. The partners L. Arbor and D. Barnett share income and net loss equally, so it's going to be 50-50 there, 16 and 16. So it's going to, because it's income, it's going to look like this one. The income summary will be debited for the 32, and each one of their capital accounts would be credited for the 16. You can see that journal entry in your book. Now, it says that drawings for the year were 8,000 for Arbor and 6,000 for Barnett, and you can see that in the journal entry right underneath it, which is going to be step number 4, closing entry number 4. Each one of their capital accounts is debited for their amount, so Arbor is going to be debited for the 8, Barnett's going to be debited for the 6, and their drawings will be closed out with credit. Now, it is possible that you have different ratios rather than 50-50. Like I said before, you could have 60-40, 60%, 40%. Income ratios can be expressed in several different ways. It can be done as a proportion. You might see something that looks like 6-4. Because these two equal 10, you can say 60%, 40%. Whoops. Got the 0 in there for 40. Okay, so you could change that to a percent. You could change it to a fraction. You can say 2/3, 1/3. Okay, so they can be expressed many different ways, and I will show you how to work them. The income ratio is actually chosen to reflect the differences among the partners in the terms of capital investment and the things that they do within the partnership itself. So if you manage the partnership daily, then you're probably going to have a little bit higher percent coming back to you than the person who's not daily active in the business. This note for the test, when we talk about income ratios, is the basis for sharing the partnership's income and loss. It's how we split this right here, the income or the loss that we have for the partnership at the end of its closing entries. Know that for the test. The objective is to choose the method that best represents the partner's capital investments and their services within the business itself. So if you're just putting up the money, not doing the work, but if you're doing the work, you should be compensated. A fixed ratio is expressed as a proportion, percentage, or a fraction. That's these things right here that I just showed you. We're going to take a look at brief exercise 12.3. So going back to page 31. All right, it says Rod Dow Company reports net income of $75,000. The income ratios are Rod 60% and Dow 40%. So what you would do, the first thing I like to do is I like to say, okay, tell you what we're doing here. We have $75,000 to split between them, and one of them gets 60%. So that's the first thing I want to do is find out what that 60% is. 60% of 75 is 45. So I'm dealing with one person at 45, and if I take 45 away from 75, then I'm dealing with the second person at 30. I got my numbers. Next thing I got to do is just figure out how to put it into the journal entry for the closing journal entries for number 3. So it is net income. So in order to get rid of the net income, I have to debit income summary and credit their capital accounts. We know that the total income is the 75. We know that Rod gets the 60%, Dow gets the 40. And that's how your journal entry number 3 for your closing entries should look for that. Pretty easy peasy when it's just something like that. However, it can be a ratio based either on the capital balance at the beginning of the year or on an average capital balance during the year. You could have salaries paid to the partners with the remainder done on an income or loss distribution fixed amount. So we're going to now take a look at number 4, and that's going to be a little bit different. PFW Company reports net income of $45,000. Partner salary allowances are Pitts 15, Filbert 5, and Witten 5. Indicate the division of net income to each partner, assuming that the income ratio is 50%, 30%, 20%, or 50-30-20. So now we're going to kind of have to start a chart, which is what your handout that you're going to want to, income distribution handout that's going to be on Moodle that you're going to want to print out. So this is kind of sort of like what you're going to be doing on there. So number 4, you're going to start with, I like to start with putting who they are across the top. So we're going to have Pitts, Filbert, and Witten. And then I like to see where we are as far as distributing the income. I also like to make note of who gets what. What is the ratios? Is it 1/3, 1/3, 1/3? Nope. In this case, it's 50, 30, and 20. Now, because these add up to 100, or if I take the zeros off, 10, same, I can say 50%, 30%, and 20%. So I'm going to start with So I'm going to start us off here with a net income of 45, and I'm going to work my way down from there. They had some salaries that has to come out. No matter what that does to the income amount, at the end, we have to do the salaries if it's put in the partnership agreement. So Pitts is going to take a salary of $15,000. Filbert's going to take a salary of 5, and Witten is going to take a salary of 5. So now I want to add these across and see how much I've taken away from this. So 15, 20, 25. So I'm going to take away 25, which leaves me with 20 to go. At that point, that's when I start looking at these, okay, the ratios. So splitting it out. Per their ratio. So I'm going to take 50% of 20,000. Well, that's easy enough. Pitts is going to get 10. Okay. Then I'm going to take 30% of 20, which is 6,000. And if I have 16 out of the 20, then Witten is going to get 4,000. Because these then have to add up to the remaining 20. So that I have 0 income left to get rid of when we get down to the bottom. So then I go through and I add these guys down to find out what they have. So Pitts had 15 and 10, so he gets 25 of the 45. Filbert gets 11, and Witten gets 9. So in my closing entry number 3, I would debit income summary for the 45, credit Pitts capital for the 25, Filbert capital for the 11, and Witten capital for the 9, and distribute income that way in the 3rd journal entry. Now, not only can they have to pay salaries per the partnership agreement, but they might also have to pay what's called interest. And the interest can be done on the capital balances. The partnership agreement will tell you which one. It's usually, I think, the ending capital balance, what they have left at the end of the year. But you calculate interest on their capital, and then you go to salaries, and then you go to, or maybe it's salaries first. No, interest, and then salaries, and then the ratios. So we're going to look at number 5 real quick. And then come back to the lecture. And number 5 is going to use new people. So get rid of this. Number 5 says, NAB and Fry Company reports net income of $31,000. Interest allowances are NAB $7,000 and Fry $5,000. Salary allowances are NAB $15,000 and Fry $10,000. The remainder is shared equally. So again, I'm going to put their names across the top. We have NAB and Fry. And then I'm going to be looking at what we got for net income. And they are going to split 50%. 50% when we get down there. We're going to start with interest. Then we're going to look at salaries. And then we're going to look at the ratio. Okay? We're going to start with $31,000 worth of that up. I wrote it down too far. Okay, NAB has interest. That's where we're going to start. At 7,000, Fry has 5. So at this point, we're going to take 12 away from the 31, which is going to leave us with 19. Then we're going to take a look at salaries. Said NAB is going to get 15,000. is gonna get 10,000. So we're gonna take 25,000 away from 19,000. Does that sound like a problem? 'Cause if it doesn't, it should. We have overgiven to these people, but we have to do what the partnership agreement says, no matter what it does to this column right now. Okay, so they have to get their interest, they have to get their salaries. But what that has done is that has thrown us short 6,000. Okay, you have to do the interest, you have to do the salaries, and then find out where you set. Well, right here, we've overgiven. So at this point, we go back and look at the ratios, because remember, this ratio is not just for income, but it's also for loss. So if we've overgiven, then we've got to take some away. Well, how much do we take away? 50-50. So we're going to take that 6,000 and split it, taking away from the two of them. So we're going to take 3,000 away from NAB, 3,000 away from Fry, which puts 6,000 back in, which makes us now 0. Okay, now you do the math down to find out how much each one's going to get in the journal entry when you split this much out. So you're going to give NAB 19, and Fry is going to get 12. So again, it's income. So you're going to debit income summary for the 31. You're going to credit NAB's capital for 19 and Fry's capital for 12. I think these are kind of fun. So that is what your allocation, I believe there's an allocation handout. Could be wrong, but you will be doing that on the test, I'm sure. So back to your lecture real quick. So back to the book. We are going to look at where it says where it talks about salaries, interest, and remainder on a fixed ratio on page 10. Somewhere in there, it's going to tell you that the salaries paid to the partners, interest is paid to the partners on the capital balance with the remainder on the fixed ratios, and that this is done regardless of what it does to this net income amount, just like we did here. We had to do these first two things, and it made us short, but we fixed it because we fixed it by taking away with their income ratio parts instead of giving them some. So know how that works and know that that's how that works for the test. Salaries and interests are not expenses to the partnership, since partners are not employees or creditors. Instead, these are going to be debited to their draw accounts. Brief exercise. Oh, we just did brief exercise 5, so we're good there. Okay, partnership financial statements. These are similar to a sole proprietor, except the division of net income is going to be shown on the income statement. If you look at illustration 12.5 on page 10, you can see that it kind of does something similar to this in the division of net income for Kingsley Company. It's going to show the salary allowances, the interest allowances, and then the remaining distributed per the partnership agreement ratios. Comes down to their total dollar amount and tells you how the $22,000 will get split between them, and then that shows you the journal entry underneath, which is basically the same thing that we've been working here. The owner's equity statement, if you look on page 11, is now called the partner's capital statement. What you need to know for the test is the owner's equity statement or the partner's capital statement explains the changes in the capital balances during the year. So you can take a look at, it's kind of like doing an owner's equity statement for each partner, only you put them all in one chart. So you've got their beginning capital, any additional investment, their net income distribution, which we calculate using these charts over here on the division of net income. Subtract out their draws, and you have their new capital balances. So it's kind of like doing a owner's equity statement for each one of them, but putting it together all on one chart. Each partner's capital balance is reported on the balance sheet. You can see that at the bottom on illustration 12.8. Each one of them, and you need to know that for the test, each one of their partner capital accounts will show under owner's equity separately. So Sarah King's capital shows and Ray Lee capital shows. They each have their own specific line. What you need to know also from the test is the kinds of things that causes an increase of capital, and that would be the things that would be listed up above in the partner's capital statement. So like the additional investment, net income, if it's the first time in business, then it would be their initial investment. So those are the types of things that would make the capital balances increase, and you need to know that for the test. Now we are going to jump back to page 18 for a second, and we're going to cover part of the appendix. We're going to talk about additions and subtractions or withdrawals of partners, because remember how I said that changes the partnership, and we need to know how to handle that. So we are going to cover the appendix in this chapter, and there is going to be a part of an appendix exercise on your test. We're going to start with the admission of a partner on page 18. Know for the test that with an admission of a partner, there's a legal dissolution of the old partnership and a beginning of a new one. Like I said, if we had two people involved in the partnership and somebody else decides to join, then the old one is no longer. We don't have a two-way partnership anymore. You have a new three-way partnership, so you have to start this all over. There's two ways that this can be done. You can purchase a partner's interest, and that is a personal transaction between one or more existing partners and the new partner. I like to call this a pocket-to-pocket transaction. It's a personal purchase. So the money goes from the new partner's pocket to the old partner's pocket. No money goes to the partnership, okay? The only thing we do is realign capital. So you're going to bring somebody in, but one of the partners is giving some of their capital up in exchange. They are taking the cash. So all you're doing is rearranging capital. You're giving the new partner the old partner's capital, and that's it. So if we take a look at the example on page 19, it says, about down after the bullet points there, to illustrate, assume that L. Carson agrees to pay $10,000 each to C. Ames and D. Barker for 33 1/3 or 1/3 of their interest in the Ames-Barker partnership. At the time of the admission of Carson, each partner had a $30,000 capital balance. Both partners therefore give up $10,000, or you take 30,000 times 1/3 of their capital equity. So Ames and Barker are both going to give Carson $10,000 worth of capital. Carson is going to give them the money, and their money goes in their pocket. So you won't be doing anything with cash on the partnership. So it's going to look like what it looks like there in the book. You're going to debit C. Ames, take away $10,000 of his capital. You're going to debit D. Barker, take away $10,000 of his capital, and give both of those, the 20, to L. Carson. Now what happens is you've just rearranged the ownership. Ames now has 20,000, Barker has 20,000, and Carson has 20,000. So it's 1/3, 1/3, 1/3 ownership. So and that's what we were aiming for. So that's how we do it if it's a purchase of a partner's interest. Again, it's pocket to pocket, no cash to the partnership. Let's work another one real quick. So flip back a few pages to brief exercise 7 on page 31. Gamma Company capital balances are Bar 30,000, Croy 25,000, and Eubank 22,000. The partners share income equally. Tovar is admitted to the firm by purchasing 1/2 of Eubank's interest for $13,000. This is where it gets fun. Journalize the admission of Tovar to the partnership. So we're going to look at Eubank real quick. He has a capital balance of $22,000. Tovar wants to come in. So that's who we've got to fix here. Okay? Tovar is buying 1/2 of this interest. So what is 1/2 of 22? Well, it's 11. So we've got to take 11 away from here and put it here. Okay? But Tovar's given Eubanks $13,000 for that. Do I care? No. Because the money that Tovar gives Eubank goes in Eubank's pocket, not the partnership. So the partnership books does not care. So all I want to do is fix this capital, and that's it on the company books. So it doesn't matter what he gave. He could have given $8,000 for it. He could have given $25,000 for it. It doesn't matter how much it says he paid him for it, because the partnership doesn't see any of it. So we're just going to move some of this capital into this capital. So I'm going to take 11 from here, which means I'm going to debit that. And give it to Tovar. Did I fix it? We took half of this guy's away, so he's now left with 11. And Tovar now has $11,000 worth of capital. Yes, he took half of his interest. The money went from this guy to this guy. The partnership may not even know how much this guy gave this guy, because it doesn't matter in a personal purchase. All right, don't lose your spot there in the brief exercises, but we're going to talk about what happens, though, if instead of one person giving the other person the cash, this person actually invests into the partnership itself. That would mean that the partnership gets the money. So we are going to be looking at debiting cash. Now, very rarely does a partner come in with a cash investment of what he's actually getting in capital. So know that right up front. Kind of like Eubanks and Tovar here. Tovar gave Eubanks $13,000 for $11,000 worth of capital. It is quite possible to bring somebody in with a cash investment into the business for a different amount than what they're getting in capital from the business. So at that point, you're going to be looking at somebody gets a bonus. Either the partnership is happy because they're giving this guy less capital than what they're getting in cash, which means they've got more money than what they've given out in capital, which makes the partnership happy, or it could be a bonus to the new person coming in, which means he gave less cash than what he's going to get in capital, so he got more out of the deal than he paid. So you're going to see how that works out here in a second. Let's go ahead and let me tell you what you need to know from this part. Investments of asset into a partnership is an actual transaction between the new partner and the partnership. That's why the cash goes to the partnership. This, note for the test, increases net assets and the net capital of the partnership. Because when the assets go up, then the capital has to go up. Remember, one side can't go up and the other side not change in an accounting equation. That's the whole point. It has to be equal. So I'm going to show you how to work that through. So let's go ahead and, again, we're going to be looking at bonuses. The easiest way to do that is going to be to actually work one. So let's go back to brief exercise 8 on page 31. In Eastwood Company, capital balances are IRA, $40,000, and Pedigo, $50,000. The partners share income equally. Vernon is admitted to the firm with a 45% interest by an investment of cash of $58,000. Journalize the admission of Vernon. exercise 12.8. I like to get all of my ducks in a row and then do the journal entries. So I get all of the things I need to know and then I plug the stuff. So I'm going to take a look at first my beginning capital. This is before anything having to do with Vernon. So I'm going to take a look at who we have. We have IRA and Pedigo. They have $40,000 and $50,000. So my beginning capital for this partnership before we started is $90,000. Okay. Vertigo is going to Vernon is going to invest $58,000. So the new capital amount for the partnership is going to be these two added together, or 148. Now for Vernon to come in, he wants a 45% interest. So I have to take a look at how much that is. 45% of 148,000 is 66,600. If Vernon wants 45% of the partnership's total interest, then he has to have a capital balance of 66,600 from an investment of 58. Okay, so we have all of our ducks, kind of, because this is different than this. Remember how I told you what they get in capital is usually not going to be what they've invested. There's a difference here. That is called the bonus. It doesn't matter which direction you do the math. I always like to start with a higher number. We have 66,600, so I'm going to show you how to work it without even having to think about it, and then we'll think about it. Take away the 58. So the bonus is 8,600. Now, is the bonus to the new partner or the bonus to the partnership? Don't think about it. We'll work on that, okay? Then we'll talk it out. So let's plug the things we know. We know that this is Vernon's cash investment. So if he is buying this interest in the partnership through an investment, then he's giving that much money to the partnership. So we're going to debit cash. We also know that he is going to take away this much capital. So we're going to give it to him. We also know that rule number 2 in Accounting 101 states that debits must equal credits. So the only place that this difference can come from or go to is the other two partners. So we need more here, so there you're going to have to be debited. That's what I'm saying. Don't think about it, just do it. We have IRA, capital, and Pedigo. And they have to be debited because that's where I need more money. I have 66 here already, 58 over here, so I've got to make these two balance. We have $8,600 difference between those two numbers. We already figured that out. And we also know that IRA and Pedigo are 50-50. So if I take this 8,600 and divide it by 2, I'm going to get 4,300. So each one of them has to have a number of 4,300 for this to balance. Now we're going to talk about what has happened. Told you don't think about it, just fill in the blanks. So let's talk about what happened. Vernon got this much interest in the partnership by paying this much in. who's happy here? The partnership or Vernon? Well, Vernon is, because he only gave 58,000 and he got 66,600. So the bonus this time went to the new partner. We say that the bonus went there because he got more than what he paid, and these two had to give up some of their ownership to bring him in. So the bonus did not go to the old partners. In this case, it went to the new partner. Okay? What happens if we take a look? I don't think. Look here a second. That was number 8. We don't have. Let's go back to the chapter and look at the other side of that. So going back to page 19. Let's take a look on page 20, where it says bonus to old partners. We're going to see how this works the other way around. So I'm going to leave my descriptions and erase everything else, because we're going to now not work a brief exercise, but we're going to work the one that's in the book. All right, it says, to illustrate, down towards the bottom of the page, assume that the Bart Cohen partnership owned by Sam Bart and Tom Cohen has total capital of $120,000. Leah Eden acquires a 25% ownership in the partnership by making a cash investment of $80,000. So, the old partners, before Eden comes in, up above it's going to tell you the beginning capital is 120. So we're going to start with a beginning capital of 120. Leah Eden is going to invest 80,000. So her investment is 80,000, which is going to take the value of the partnership up to 200. She wants a 25% interest, which means that she wants $50,000 in capital. Okay, so now we're going to start plugging that into a journal entry. So we know right off the bat that they are going to get cash. So we're going to put in her investment into the partnership of 80,000. We're going to give her 50,000. Now to calculate that bonus again, you compare these two. 80,000 minus 50,000 is somewhere, there's a $30,000 bonus. Okay? And it says that Bart and Cohen are going to share 60-40. So if I take the 30,000 times 60% for Bart, then I'm going to get 18. And if Bart gets 18, then 12 is Cohen, because the two of them is going to equal to 30. So now again, I'm not going to think about it or think about who's getting what, but I'm going to fix my journal entry because debits have to equal credit. So those are going to have to now go on the credit side. So Bart Capital is going to have to get credited for 18, and Cohen is going to have to get credited for 12. In order for this journal entry to balance. Okay? about what happened. Eden got $50,000 worth of capital, but paid $80,000. So is Eden happy with this transaction? No. She paid $80,000 and got $50,000. Who's happy? These two old partners, because they got more capital. They got the bonus. So in the first example, the new partner coming in got the bonus. That tells me that the old partners wanted that new person to come in. If Eden is willing to take $50,000 but pay $30,000 more for that $50,000, then Eden wants in to the partnership. That's the way I try to look at it. So that is admitting a partner through a personal transaction as well as an actual investment into the business. Now, a withdrawal is pretty close to the same. So page 21, down towards the bottom. This can be done by a voluntary withdrawal by selling their portion of the partnership, or an involuntary by reaching a retirement age per the partnership agreement, or by dying. Either way, they're done. So that creates a new partnership. So they would have to withdraw. Now, just as admitting a new partner creates a new partnership, so does the withdrawal of a partner. So we have to take a look at how to reconfigure things. Again, this can be a personal transaction. Handle it the same way we did when we admitted a partner. You're going to realign capital balances, and that's it. So if you flip the page, it can say down above that first yellow part there, it says, to illustrate, assume the partners Moore's Need and Odom have capital balances of $25,000, $15,000, and $10,000 respectively. Moore's and Need agreed to buy out Odom's interest. Each of them agrees to pay Odom $8,000 in exchange for 1/2 of Odom's total interest of $10,000. Do we really care how much they are paying him to leave? No, because the cash goes in a personal transaction from pocket to pocket. So as you can see on page 22, we just simply wipe out Odom's capital and give Moore's and Need $5,000 each. The $8,000 that they paid for it went straight to Odom's pocket. So it's the same thing, only you're now taking somebody completely out of the mix. It's a purchase of by personal, which means it's pocket to pocket for the cash. So no cash is involved. If there is a payment from the partnership to the person withdrawing, then that's just like somebody coming in and investing cash into the partnership. So again, we are going to be looking at bonuses. So let me put some board work here. And we'll take a look at how this works. Partnership assets are going to go down, and partnership capital is going to go down. Just like the opposite. When we admit somebody, the assets went up because they put cash in, and the capital went up. Asset evaluations are not recorded. This is due to the cost principle, so they should be recorded at cost, as well as the going concern assumption, which assumes that a business is planning to continue operations indefinitely. So you're just doing some rearranging here. Things are still going to continue. Instead, any difference between the amount paid and the withdrawing partner's capital balance should be considered a bonus to the retiring partner or the remaining partners. So let's take a look at the book where it says bonus to retiring partner on page 23. This is going to occur when the fair market value of partnership assets is more than their book value, when there's unreported goodwill resulting from the partnership's superior earnings record, or the remaining partners are anxious to remove the partner from the business. So let's take a look at what it shows here after the bold part. To illustrate, assume that the following capital balances exist in the RST partnership. We have Roman of 50,000, Sand of 30,000, and Turk of 20,000. The partners share income in the ratio of 3-to-1 respectively. Turk retires from the partnership and receives a cash payment of $25,000 from the firm. So we're going to actually take a look. I like to write everything down, like I said, and know where I'm at. So we have Roman, Sand, and Turk. And we have 50, 30, and 20. And they are going to share 3, 2, and 1. 3, 2, and 1. Now, that doesn't equal 10. That doesn't equal 100. So we have a problem. So what we have to do is we have to add these up. We have 3, 4, 5, 6. So this guy is 3/6, this person is 2/6, and this person is 1/6. Now, 2 of those fractions can be reduced, but let's just leave them alone for right now. Okay? So that is how they would have shared income at that point. We are going to determine the amount of the bonus first. We're going to subtract the retiring partner's capital balance from the cash paid from the partnership. So Turk has 20,000, but he's going to be paid 25. Okay. So we determine the amount of the bonus. We're going to allocate the bonus according to the income ratios, just like we did before. But here's the thing. If Turk is leaving, Turk can't play anymore because he's gone. So now I don't have 6. I have 3 and 2, which means I have 3/5 and 2/5. Because Turk is no longer going to be part of this. So I have to take the 5,000 times 3/5 for Roman. So I would take the 5,000 times 3 and divide it by 5. That would be Roman. Okay, and if I do that, that is going to give me 3,000. And if I have a $5,000 bonus, Sand gets the other 2. So now let's plug the things we know. We know that Turk is going to completely go away. So if we want this to go to 0, then we have to debit it out. We also know that the partnership is paying him $25,000 to leave. So the partnership cash is going down 25. Again, we're not going to think about it. We just know that rule number 2 in 101 says that debits have to equal credits, which means the rest of them have to go here. So Roman and Sand capital have to go on the debit side in order to make that balance. Now, if you want to think it out, Turk was paid $25,000 for $20,000 for the capital. He's happy camper. These guys wanted him gone because they were willing to give up some of their own personal capital to get him out. Now, if you work this through and it comes out the other way, where you have to credit the other partners, remaining partners, then they're gonna be happy and the person who's leaving is not. So let's take a look at how that works. So at the bottom of the page, we're gonna start it out. Turk is going to only get paid 16. So this will be kind of simple because we're gonna stick with the same numbers. We're gonna pay him out at 16. His capital is 20, so the bonus is 4,000. Again, we have 3/5. So if we had 3/5 going to Roman, we have 2,400 going to Roman and 16 going to Sam. Okay, so we're gonna come over here. We're gonna plug the things we know. We know that Turk is leaving with $20,000 of capital that has to be gotten rid of. We know that we're going to pay him 16. Rule number 2 says debits have to equal credits, so we're going to put these two in where we need them, which is on the credit side now. Roman and San for 24 and 16. Turk is leaving with $20,000 worth of capital in his account, but he's only going to go walking away with 16,000. He's not so happy this time, but these guys are, because they're getting their capitals bumped up a little bit, because remember, capital likes to be a credit. Okay, so let's go ahead and flip to page 24. We're going to talk about death of a partner real quick. This is also going to result in the dissolution or the no more of a partnership. Agreements usually provide for the surviving partners to continue with the operations uninterrupted. Interest can be purchased with personal assets or partnership assets, depending on how the partnership agreement has it stated. Sometimes when the agreement calls for partnerships to be bought from partnership assets for payments to be from the partnership itself, then life insurance policies are taken out on the partners with the partnership itself listed as a beneficiary. So in that case, if Turk actually passed away and it was paid with by the partnership funds, there would have probably been a life insurance policy on all of the partners, and that would be used to buy out his interest there. The funds are then used to pay the deceased partner's estate, and this agreement may also at this point call for an independent audit and a revaluation of business assets, so that might happen as well. Either way, you have to determine when the partner dies, you have to determine the partner's equity at the time of death. So you have to do 3 things, and you need to know these 3 things for the test. They are listed out on page 24. The first thing you have to do is determine the net income or loss for the year to date. So you're going to stop if today is the date of death, then today is the last day of that partnership. So that is when you need to know what the net income is for the year. Then you're going to close the books. So you're going to do the 4 journal entries that close it out and divide out the income or loss. And you're going to prepare the financial statements for that particular point in time. So those 3 things, know for the test, you have to do upon the death of a partner. Now, I think we have just one more section here to cover in chapter 12. So we're going to go back to page 12 and look at liquidation. These are kind of fun. Not always fun if you are in a partnership, because that means that the partnership is going to be no more. But I think the actual accounting work for them is kind of fun to do. There's really only one way that it's going to be done actually in the accounting books, but there's a chart way that is kind of fun to see how it all comes together. We are going to do the journal entry way. The liquidation of a partnership can result from the sale of a business by mutual agreement of the partners. It can happen because of the death of a partner, or it can happen from bankruptcy. You see these liquidation sales for businesses a lot of times that are just closing their doors. everything has to go, you know, come and shop and buy us out type of thing. Know for the test that the liquidation ends both the legal and economic life of the partnership. It is no more. It's done. The partnership should complete the accounting cycle through the closing entries for the period prior to the liquidation so that only balance sheet accounts remain open. Because remember, the closing entries close all those temporary accounts. We talked about that earlier. The revenues, the expenses, the income summary account itself, the draw accounts. So the only thing you have left when you're done with closing entries is the balance sheet accounts. Your assets, your liabilities, and your capital accounts. That's what you want to get down to before you start doing these liquidation entries. There are steps to doing a liquidation, and they're going to be found at the bottom of page 12. The first one, and you need to know these for the test, and this is what you're going to be working for the test. Each step has to be performed in this particular order. You can't mess them around. So number one is to sell all non-cash assets for cash and recognize your gain or loss on that realization. What I mean by recognize the gain or loss on that realization is, let's say all of our non-cash assets have a value of $10,000. If we got $8,000 for them, we sold them for $8,000. That means we have a realized loss of 2. Okay? Why? Because we have a value of $10,000 on our books. We only got 8, which means we lost $2,000 in that deal. Could it go the other way? Could we have a value of $10,000 and we got 15 for it? So we have a realized gain. Yes. Doesn't happen very often in a liquidation. Okay. When you are liquidating things to go out of business, you are selling things for pennies on the dollar generally. So usually this is the more typical case. So we recognize that gain or loss. And step number 2 then, we take that gain or loss and we split it between the partners. And we use income ratios for that. So if it's not stated, it's automatically 50-50 or equally, 1/3, 1/3, 1/3. But you go back to how they're going to split their income ratios and you divide this net realized loss or gain out between those partners. That zeroes this account out. Okay, so in this mix, just to keep things simple, we said we're going to have cash, obviously. We're going to have non-cash assets, which is, in reality, you're going to have a whole bunch of different accounts here that you're going to be dealing with. We just simplify it for the class. You're going to have like supplies and accounts receivable and equipment and maybe vehicles. You're going to have all kinds of accounts that are really going to be used here, but we're going to kind of just throw them all in a pot and call it non-cash assets to keep it simple. So you're going to have cash, non-cash assets, then you're going to have liabilities that you would maybe still owe somebody. And then you're going to have your capital account. Okay? Remember, your assets equal your liabilities plus your owner's equity. Okay? In the journal entry number 1, you're going to sell your non-cash assets for cash, which is going to make them go away. Okay? But you're going to have an unrealized, or you're going to have a realized gain or loss on sale of planned assets. And that's going to be in your journal entry. Well, in step number 2, you're going to get rid of that gain or loss and put it in these guys. Okay, and we'll work this through in a second. I'm just kind of showing you on a chart. At that point, then, you don't have this account anymore. You don't have this account. You're down to cash, liabilities, and capital. And the next thing you want to do is pay your people that you owe with your cash. So then your liabilities are now gone. So now then you are left with just cash and their capital balances, and they should equal. So you give them the cash you zero out their capital balances, and you're done. So let's work it through with actual numbers and see how it goes. Let's go back and okay, let's take a look at the example on page 1213. As you can see in the yellow, we have several things to deal with here. We have cash, accounts receivable, inventory, equipment, accumulated depreciation equipment on the asset side. On the liabilities and owner's equity side, you have notes payable, accounts payable, and the three capital balances. This is what I'm talking about that you're really going to be looking at on a company's books. So in the first one, you're going to sell your non-cash assets. So everything on the left-hand side there in the yellow, except cash. You're going to sell your accounts receivable, your inventory, your equipment, and your accum is going to go because your equipment's going. So your accum has to go. Remember, they're attached at the hip. When you do that, it says we're going to sell all that for $75,000. So you have to make all of those accounts go to zero. Accounts receivable is normal debit, inventory is a normal debit, equipment's a normal debit, but accumulated depreciation is a contra asset, which is a normal credit. So you're going to debit cash for the 75 and debit accum for the 75 or for the 8. Then you're going to credit these other ones out that are normal debits, the accounts receivable, the inventory, and the equipment. The difference between your debits and credits is that gain. Okay, in this case, those non-cash assets were had less an amount than what we got in cash. So we got more in cash than what they were worth on our books, which meant we had a gain. Then in step number 2, which, like I said, give me a second here. We're going to look through this, then we're going to go back and actually do one. Step number 2, ACE is going to allocate the $15,000 gain to the partners, okay? And the partners are going to do 3, 2, and 1, or 3, 6, 2, 6, then 1, 6. So we're going to get rid of that credit gain with a debit and do the math. The 3/6 of it, the 2/6 of it, and the 1/6 of it. And those are going to be our credits to the capital accounts. Because it's a gain, you're increasing their capital balances. If it were a loss, that would be flipped over. Your loss would be your credit, and the capital accounts would be your debits. Then you're going to pay the liabilities. Well, on the right-hand side, you've got 2. You've got notes payable and accounts payable. You've got enough cash now to do that because you have $5,000, but you took $75,000 in the first entry. So you now have $80,000 in there. So you can do that. So you're going to debit the 2 liabilities out, credit cash for the 31. So now all you're left with, if you flip the page to page 14, is the cash and the capital balances. So if you take a look, you have cash of $49,000. Our net has capital of $22,500 when you do all the, this is why we do the T accounts because it makes it simple. When you do the math, he has $22,500, Carrie has $22,800, and Eaton has $3,700. When you add those 3 capital balances up, it equals $49,000. So you give them their cash and they're done. That's the journal entry number 4 underneath. Okay, so let's go back and let's see what do it number 3 is. Number 3, A and B. Let's look at brief exercise 6. Number 3. Okay, do it number 3, part B is where we want to go. So page 32. And I am going to, you see how they do the little chart thing there? That is the fun way of doing it, but we're gonna do it in journal entries on the test. So, I am just going to put what we're gonna end up with up here so that we can take a look at that when we get down to the last entry so we can see what's going on. We have cash, Oakley, Quancy, and Ellis. And they share 3, 3, and 4. When I add that up, I have 3 plus 3 is 6, plus 4 is 10. So I have 3 tenths, 3 tenths, and 4 tenths. Okay? So in our example, we have cash has $15,000 in it. Non-cash assets, all lumped together in a pot, have $90,000. Liabilities have $40,000. Is that the same thing we're using here? No, it's not. Dang it. Okay. Let me back that up here. Looking at, do it number 3 again. Prior to the distribution of cash, the company's balances are cash 73. I was going to take you right straight there. Oakley has 47. Quancy has 14. And Ellis has 40. Okay. Oh, hold on, we're not at that one yet. Go back to 3. Sorry. This is the one I've got to talk to you another little bit about in the chapter 4. So let's go back to 3. We're going to do the journal entries. It shows the chart, but we're going to actually do the journal entries. So we have the beginning balances listed on line 2 for cash, non-cash assets, liabilities, and the 3 capitals. We are going to liquidate. Non-cash assets are going to be sold for $125,000. So we're going to get $125,000 in cash. So step number 1 said to show that cash coming in. The non-cash assets are going to be gone in full, so that's going to be a credit. Now again, this is uncommon. We got more for them than what they were worth. So 125 minus 90 is 35. So my gain, I'm just going to put gain on sale, is 35. So remember, entry number 1 is to sell the non-cash assets, realize the gain or loss. Okay? Step number 2 says distribute this gain or loss. So I'm going to take the 35,000. I'm going to work over here. And we have 3 partners. And they are 3, 2, and 3. So we have C, G, and F. Okay, so C, G, and F. C, G, and F. And we have 3, 2, and 3. So 3, 5, 6, 7, 8. Okay, so C is going to take 3/8 of that. So I'm going to take 35,000 times 3, divide by 8. 35,000 times 3, divide by 8 is 13,125. That's also going to be F. So what's left is going to go to G. So if I take 35,000 minus 13,125 minus 13,125, that's going to be 87.50. cash and capital, because I'm going to get rid of this gain on sale next. Now, if you're tracking what's going on this spreadsheet here, LR Company spreadsheet, non-cash assets are now at 0. Okay. However, cash started with 15, and it went up 125. Okay. And we have C, G, and F. Let's track what's going on with them. C has 20,000 to start, 32, and then 13. So 20, 32, and 13. Is that right? Yes. And here we gave them some more. So 13, 125. A 750. And 13, 125. Okay. Step number 3 says to pay the liabilities. So step number 3 says to get rid of the liabilities off your spreadsheet, which is 40,000. We're going to pay it in cash. We have that now. So we get rid of the liabilities with a debit. We pay it with cash. Now my liabilities are gone off that spreadsheet that's in your book, but also is $40,000 in cash. Okay, so let's see where these are now, because the non-cash assets are gone, the liabilities are gone, so we should be down to just cash and the capitals. So if we take 15,000, add the 125, subtract out the 40, we have 100,000 left. If I add these down, this one is 33,125. This one is 40,750. And this one is 26,125. What happens when you add those numbers up? 33,125, 4750, and 26,125. 100,000. So we have a debit and credits. We want everything to go to 0. Should be easy peasy at this point. We're going to get rid of these credits with debit and get rid of this debit with a credit. Every one of those accounts that you see on that spreadsheet on page 32 have zeros. Everything now in the partnership account, balance sheet has zeros. All of the general ledger accounts are 0. Okay? That is the whole goal in a liquidation. But now that is if what we call there is no capital deficiency. Is it possible to have an owner have an abnormal balance and have it be a debit instead of a credit? Yes, if they have withdrawn more than what they have in capital, taken out in draws, then they're gonna have a debit balance, because draws are a debit in the end. If you have repeat net losses and their capital doesn't cover it, then you're gonna have an abnormal debit balance in that account. That's called a capital deficiency. If a partner has a capital deficiency, they are personally liable to the partnership for that deficiency. So they should be paying the partnership for that. So if, let's say, G had a $5,000 debit balance instead of a credit balance, then he would owe the partnership that $5,000 legally. Now, unfortunately, you can't get blood out of a turnip, as the old saying goes. So if he doesn't have it, then the remaining partners have to come up with it and zero him out before this final step can be done. So you have a little extra step in here. The extra step is either G paying the capital deficiency, or it is the two making up his capital deficiency. One of the two. So you'll have that journal entry in there. So if you look in your book, capital deficiency part, if you go to the bottom of page 16, if you look at the yellow before that, you will see illustration 1212. Cash has a balance of 16. Arnett has a balance of 6. Carrie has a balance of 11.8. But Eaton has a debit balance, an abnormal capital deficiency of 1,800. Now, if Eaton is able to pay that and does, then you would do the entry at the bottom. You would debit the cash for 1,800 and credit his capital, which would take him to 0. If we add 1,800 to that cash balance that's in the yellow, that should equal the two capitals that are left, Arnett and Carrie. So you just give them their cash and they're done. If there is no way that Eaton can pay it, then you go back to the income ratios, but you take that person out, just like we did before when the person couldn't play because they were leaving Turk. We took him out of the mix. So if before the ratios were 3, 2, what was it? 3, 2, and going back to distributing 3, 2, and 1. Then now we don't have the 1 anymore because that was Eaton, so we just have the 3 and the 2. So if you look on page 17, you would have 3/5 of that deficiency coming from Arnett and 2/5 coming from Carrie. But either way, you're coming up with that 1,800. Again, you're zeroing Eaton out, and you're pulling that capital from the other two capitals balances, which then in turn would leave Wheaton at 0, like it shows in illustration 14, and the cash equaling Arnett and Carney, and or Carrie, and you give them their capital balances, and they're done. So in regards to all this liquidation set for the test, know the 4 steps. Note that in step number 4, we do not use income ratios to distribute the cash. We use their capital balances. Know what a capital deficiency is. The capital balance with a debit in it instead of a credit. Know how to handle it if there is a capital deficiency. Know that that deficiency is a personal debt to the partnership, and that should be paid by the partner that is below. And then also know that if there is non-payment of the deficiency, if that partner is not able to pay, then the remaining partners have to absorb it and take that partner that is in the hole to 0, and then that should equal the cash going out. Okay, so your homework should be on the schedule. If you have any questions, don't hesitate to get a hold of me. That is chapter 12, and if you need me, let me know. Talk to you soon.